important to you is whatever's on your mind. So yeah, don't hesitate to submit some questions, and we will do our best to get through as many as we can towards the back of the presentation. But with that, we'll go ahead and get started. One caveat I do have to give you up front is, Fidelity does not officially offer tax advice. Every individual is unique. You've got your own unique risk tolerances. Suitability constraints sort of limit us a little bit from going into exact tickers of stocks or funds, but we will certainly give you the broad strokes and an outline which we hope is extremely useful to you as you think about this concept of tax loss harvesting. So look, just up front, an old expression is that a penny saved is a penny earned. I know that I wish, and I'm sure you all wish, that every stock, every bond, every fund or ETF that we bought went up every single day. But the reality is that isn't going to happen. We've all made investments that decline in value. Some come back and end up making us a lot of money. Some don't. The good news is that an investment down in value can still help you to save money, specifically through reducing your tax bill. So today's webinar is going to focus on what is known as tax loss harvesting. Or another way of saying that is trying to make lemonade out of lemons. And again, reducing your tax bill, saving money, because again, a penny saved is just as good as a penny earned. You can see here now on this slide, just kind of a broad overview, an introduction to tax loss harvesting. What is it? Why do we want to do it? How can we manage the risk of selling something that is down? Specifically, if it was to rebound quickly, and then we end up with, instead of buyer's remorse, we end up with seller's remorse, right? We banked a loss, and suddenly a security that we owned has rocketed in value, and we feel like we've been left behind. There are some ways that we can mitigate some of that risk. We'll then spend a little bit of time just reviewing ETF tax efficiency and where it comes from. It's always one of the questions that comes up the most. We'll focus a little bit on best practices for trading and thinking about how and when to tax loss harvest. And then again, some Q&A at the end of our discussion. So with that, let's dive right into tax loss harvesting, and we can go one more slide further. So here we go. Again, I think the basic principle of tax loss harvesting is trying to save money. So let's look at an example starting on the far left of this chart. And it assumes that an individual realizes a long-term capital gain on an investment of call it $5,000. And again, this could be on anything. It could be on a stock, a bond, a fund. It doesn't really matter. But they've realized a $5,000 capital gain. And they then, if we look at the one section over on investment B, again, could be a stock, a bond, a fund, they've got a long-term loss of $4,000. So if the investor just sells investment A, she'd have a federal capital gains tax liability of something like $1,200. However, if you sell investment B and realize that $4,000 loss during the same tax year that you sold investment A at a gain, you can use that loss to partially offset the gain in investment A. So by doing this, the investor can reduce the net long-term capital gain from $5,000 to $1,000, which then reduces your tax liability from roughly $1,200 to something closer to $240, right? So again, losses aren't great. We don't want them, but to the extent that we have them, we can substantially reduce our tax bill and save some money. Trey, let's go to the next slide. So, we want to refer to tax loss harvesting as an active strategy. We'll sort of come to the conclusion of why that is at the end. But, one thing I would say is that I feel like most investors think about taxes twice a year. We think about it in April when we pay them, and we think about it in December when most people tend to do this tax loss harvesting type of strategy. But really, it should be done all the time. We should be monitoring our investments, looking for potentials to take some losses. And I think this chart does a nice job of sort of highlighting why we want to be active in looking for losses throughout the year. So I think we all know that any investment involves some risks. In this chart, we can see that just looking at the S&P 500 index, and whether it's advanced or declined every year going back to 1980. So we're talking about 44 years of returns here. So the green bars obviously reflect years where there were gains. The red bars reflect years where there were declines. And so just at a glance, overall, the S&P, we can tell, has gained in more years than it's declined. In fact, the exact number here is 8 of the last 44 years are red, right? So that's 18% of the time the market has had a negative total return over the full calendar year. What I think is slightly more interesting, though, is to draw your eye to some of these blue dots that you see, which represent the intra-year decline. So even if the year was up or down, what was the maximum drawdown that we experienced in a given year? So, for example, if we think about 2020, and I'm sure many of you remember that for all of the bad reasons, but the green bar at the end of 2020 shows that the S&P 500 was up about 20% for the year. But the blue dot indicates that the market was down over 30% at some point during that year. My guess is probably in early to mid-March. So while the S&P increased for the year, it was not a smooth uphill journey. 2020 again was COVID. It was smooth. It was anything but smooth in just about every single respect that I can think of. So yeah, the reason I bring this up is that we don't want to wait until December, the last week of December, to do our tax loss harvesting. We want to be active. We want to be thinking about our portfolio all year round. Again, I feel like most people think of taxes in April. They think about them at year end. But to maximize the amount of opportunities that we can use to bank losses to offset future gains, we should be doing that whenever possible. And those days like yesterday, they feel awful. But those are the days to be thinking and looking through your account. And are there some opportunities to possibly bank some losses? So with that, Trey, we can go to the next slide. So, again, I think that the takeaway from that last slide is that markets tend to rise over time. But an old expression that I really like is, it isn't about timing the market, it's time in the market. And that's really what helps to generate wealth and grow our assets over time. So again, it's not timing the market, but time in the market. So wherever possible, we do want to stay invested. Again, this is not to say that there aren't bumps, occasionally very big ones along the way. And reiterating what we saw in the previous slide, 8 down years since 1980, 18% of the time. But even in the up years, we've seen some pretty dramatic drawdowns. But again, the final point here is, historically, investors have been rewarded for staying invested over the long term. And we're going to take a look at some of those results on the next slide. Well, I guess it might come up in another slide. I think I'm one slide off. My bad. But here we go. And thinking about wash sale rules and the cost of, if we sell a security and then it starts to rebound quickly, or we're out of the market, like what's the negative implication of that? So the market has these normal ups and downs, and they can be very stressful to watch, especially if we're doing it every single day. I once had when I had just started in this business, which was called 28 years ago, I had a gentleman with a lot of grayish white hair tell me that investing for your future and watching your portfolio every day is like taking a cross-country trip and tracking your progress with a ruler. Right? It's really not something to watch every day. It can be overly stressful. It can lead to snap decisions that may not be in our best long-term interest. So while it is natural to have a reaction to market swings, it's important to understand the possible impact of those reactions, or in some cases, an overreaction to what, in hindsight, will become a overreaction to a normal market gyration. So it goes without saying that a common reaction in times of market decline, a lot of investors may look to pull some money out of the market. And this example on this page shows you what happens if investors react by selling. Even for a very short time period, they can miss out on a lot of potential long-term growth. So as you can see, if an investor was out of the market for just the 5 best days over the last 40 years, it has a huge impact on their total return. So what this exhibit is showing you is if you had started with $10,000 back in 1980, stayed invested through all the ups and downs, it grew to roughly 1.1 million over this time period. But if you missed just the best 5 days, and again, not surprisingly, some of those best days come after some of the worst days. So if you missed some of those best 5 days by reacting to a big down day, you can miss almost half of the upside that your return would have generated over the long term. You miss the best 10 days, you're closer to missing out on 60% of the long-term return. So again, think long term. Staying invested in the market's ups and downs gives you a much better chance to reach your long-term goals. So again, back to the expression, not timing the market, but time in the market. So now the question becomes, well, how do we blend this idea of staying invested, but also taking some tax loss trades when they become available? So we're going to get a little bit deeper into that. Sorry, I'm just seeing some questions come through as well. But Trey, let's go to the next slide. So when we think about looking for tax loss opportunities, obviously it starts with what you already own and investments that have declined in value. Probably not a surprise to most of you on this webinar that my personal account is held here at Fidelity. It's very easy for me to go into my account. I can sort all of my positions by the total amount that they have increased since I bought them, and enable me to very quickly identify the positions that have decreased the most, right? Because if you sort of rank them as you can just click a button, it toggles, and it'll rank your positions from those that have increased the most in value to those that have decreased the most in value. So in some cases, you may have bought a security multiple times, in which case it's just one additional click where you need to go in and look at each individual tax lot. Again, if you've been dollar cost averaging into security, you may be up in the position overall, but you may have some tax lots that are down in value. So again, it's readily available on fidelity.com in your account. And if your account might be somewhere else, I'm sure that same type of functionality does exist. So that's where we want to start, is by looking for these positions that have declined in value, and it's relatively straightforward to do. So Trey, if we go to the next slide, look, it's been actually a pretty good couple of years on the equity front. There are obviously always funds that may have done poorly even in a bull market. But the area where I feel most investors are going to have some tax loss opportunities this year are in fixed income. And again, we have to be careful and anonymize here and refer to them as ETF A, B, and C. These are real funds, but again, not knowing suitability of all of you who might be on the call, we kind of have to anonymize it. But again, this is broadly representative, and I will tell you that ETF A is an index-based core bond fund. ETFB is an actively managed core bond fund, and ETFC is also an actively managed core bond fund. So this is a real example. We're looking again at fixed income, which has generally had negative price returns over 3 and 5 year periods. And again, we've got an index fund. We've got 2 active core bond funds. So again, when thinking about tax loss harvesting, and forgive me again for the disclaimer, but Fidelity does not offer tax advice. You really should check with a tax advisor. But the general IRS guidelines are that you cannot sell an investment for a loss and buy back a substantially similar exposure within 30 days. So in this example, by moving from one issuer with an index product to another that offers an active exposure to that same asset class is a relatively easy way to stay in compliance with IRS guidelines. These trades are still likely to be highly correlated, right? If we look at the price returns, is there a difference? Absolutely. Is it directionally in the same move? Of course it is. And we do see, especially when you go to the total return over 5 years, the index fund at negative 0.4, the active fund at positive 0.6, and the third one at positive 5.9. That's a total return over a 5-year period. So, we're within sort of 1% on an annualized basis, if you will. So highly correlated, moving in the same direction, but different strategies. Again, some are index, some are active, and the active funds are going to have different holdings because they're being managed by different providers. So these trades, again, are likely to be highly correlated. If you were to sell one and buy another, the chances of the entire asset class ripping and you being completely left behind if you took the loss and reinvested into a new one are pretty low, right? Whereas if you just sold it, we're out of the market entirely. That's where I think the timing the market becomes an issue for a lot of people. So again, in this example, if you were to sell ETF A and buy ETF C, you remain fully invested. You can take your tax loss and stay in compliance with IRS wash sale guidelines. So Trey, let's go on to the next couple of slides where really we're going to talk a little bit more about ETF trading and ETF tax efficiency. So this is something that comes up on almost every webinar we do. Even if we're addressing it, we still tend to get questions, which is why are ETFs more tax efficient than mutual funds? And so we're going to walk through that and hopefully leave you with a much deeper and better understanding. But the primary thing I want you to notice is at the top of the slide, the mutual fund trade process, buyers and sellers of mutual funds are transacting directly with the mutual fund. So if I want to buy $1,000 of ABC mutual fund, I send my cash into the fund, and the manager of that fund then goes to the market and they buy the securities that they want. Similarly, if I want $1,000 back from the fund, they go to the market. Again, it could be stocks, could be bonds. They sell off the securities that they want to sell to give me back my money. But what happens is when I ask for my money back and they sell securities, those securities are being sold inside the fund, inside the mutual fund. So if anything the fund sells is at a gain, that gain is realized inside the fund, and at the end of the year is then spread over all of the long-term holders of the mutual fund. Let's now compare that to an ETF. And this is the same whether it's an active or an index-based product. So here we're looking at the bottom of the slide, and we can basically see that the exchange has simply just moved closer to the buyers and the sellers. And the reason is these are exchange-traded funds, right? So the funds are traded directly on the exchange, which basically means that buyers and sellers are trading, for the most part, with each other. Trades are executed on the exchange. So when I go and put my money and say I want to go and buy, Fund A, I get back shares if I want to buy, an ETF, I get back shares in the ETF. And when I sell it, again, it's executed on the exchange and I get my money back. So importantly, if I sell the fund down the line, I came into it at a cost of 50, I got out at 60. I have a $10 capital gain. But all of the other holders of the ETF are completely unimpacted by my decision to buy or sell the fund. If we go to the next slide, we can dig a little bit deeper into the notion of, well, that's all fine and good as long as there's a balance of buyers and sellers. But sometimes there is more of one than there is of the other. So, if we think about the largest ETFs in the market, there's usually a very good number of buyers and sellers of a fund. Every trade you make, if you're, it could be on Intel, Disney, it could be on an ETF. If you're buying it, somebody else is selling it, and the trades are just sort of matched up. But when there is an imbalance, for example, there's many more buy orders than sell orders, the price of the ETF on the exchange will go up. Right? It will be bid up a little bit. So for simplicity's sake, let's say we're talking about an S&P 500 ETF. If the price of the ETF goes slightly above the value of its underlying holdings, there are large institutional investors who are basically monitoring that. What's the price of the ETF? What's the price of the underlying holdings? And if the value of the ETF is higher than the value of the underlying holdings, they will immediately go into the market, buy up the underlying constituents. Again, the S&P 500 stocks, they will deliver them to the ETF issuer, get back shares in the ETF, and start selling them into the market. So there's a little bit of an arbitrage in there available for these institutional investors known as authorized participants, or APs. There's a little bit of arbitrage, but ETFs generally have, it could be anywhere from 10 to 30 different APs who are all watching these prices. So the dislocation, if you will, between the price of the ETF on the exchange and the value of its baskets tends to be like pennies. And I know we've all seen the headlines in a newspaper or on CNBC that a certain ETF is broken. It's trading, slightly higher or lower than its underlying holdings. But again, the point I would make to you is, we're talking about very large institutional trading desks who do arbitrage for a living, and they would literally steamroll each other for a nickel. So these discrepancies between the price of the ETF and the value of its underlying holdings tends to remain very tight, particularly with larger and more liquid ETFs. And these APs basically ensure that the supply and demand of the ETF remains in balance. So the most important thing here is, again, if the ETF starts to trade a little bit rich, meaning above the value of its holdings, they're buying the individual holdings, they deliver them to the ETF in kind, and get back shares in the ETF. And on the way out, again, if the ETF was trading a little bit cheap, they start buying up shares in the ETF, they deliver them back to the issuer. The issuer then gives them the underlying holdings, again, in kind. And the reason this term in kind is so important is because it is a non-taxable event in the tax code. It's an in-kind delivery. So again, instead of cash coming in or out of the fund, it's securities. And by doing it that way, there are no capital gains triggered through this creation redemption mechanism. So I hope that's clear, and we can certainly come back to it during Q&A. I think the expression that people know is the proof is in the pudding, but that's actually a misquote. It's the proof of the pudding is in the eating, is what they actually say. But regardless, let's look at the proof point of ETFs being more tax efficient than mutual funds. And again, due to the in-kind creation redemption process, ETFs typically don't pay out capital gains annually. Instead, investors, again, realize a gain or a loss when they actually exit their position. So this slide shows you some of the historical context on distributions and comparing mutual funds to ETFs. And you'll see that ETFs have historically distributed significantly less often, as well as smaller amounts than comparable mutual funds. So if we look on the far left, the three green bars. The green bars are the equity mutual funds, and compare that to the blue bars on the far left. Those are the equity ETFs. We can see that the likelihood of an ETF paying a capital gain is much lower. So for example, the middle bar, which is 2022, which by the way was a down year for the market, even in a down year in 2022, roughly 60% of mutual funds paid out a capital gain versus just 11% of ETFs that paid a capital gain, right? So substantially fewer ETFs paid as a percentage of all outstanding ETFs and mutual funds, substantially fewer paid out a capital gain. Perhaps the bigger story, though, is on the right side, because even when the ETFs have paid out, the amount tends to be significantly smaller. So again, looking at 2022, the middle bars, if we look at the green, which is the mutual funds, on average, the funds that paid out 5.1% of their net asset value. So 5.1% of the fund was paid out as a gain on average for mutual funds. You compare that to the ETF, it's less than 1%. So again, the key takeaway is ETFs tend to pay less often, and when they do pay, it tends to be substantially lower. And all of this is a result of the in-kind creation redemption mechanism, as opposed to cash, which is generally used to create and redeem shares in mutual funds. Trey, let's go to the next couple of slides. We'll go one more. So again, this gets to the point that I was making earlier of like the ETF will generally trade in line with the value of its holdings. So if we look at that big blue box in the middle that says net asset value of 950, that means that the ETF's underlying holdings are worth $9.50. But each of those underlying holdings, again, let's assume we're talking about like small cap stocks and the Russell 2000 as an example. There's a spread on each of those underlying stocks, right? There's a price at which you can buy it, and there's a price at which you can sell it on the underlying stocks, and they're generally not the same. There's a spread, bid-ask spreads. So if we think about the Russell 2000, it may be on the left-hand side that the buyers are willing to pay $9.45. The sellers are asking for $9.55. What we tend to find is that the ETF will trade within the bid and the offer of the underlying basket. So again, of that Russell 2000. So if 945 is being what's bid on this basket and 955 is what's being asked, the ETF is generally going to trade between 945 and 955. When that's happening and we're trading within that narrow spread, creation and redemption, or this in-kind mechanism, will not come into play really at all. What tends to happen is if there are substantially more buyers than sellers, and the price of the ETF is going to drift towards the right side, right? So to the 955. And if there's a ton of demand, maybe it gets to 956, 957. At that type of price, at 957, again, an authorized participant or one of these institutional trading desks can go into the market, buy up all of the holdings in the ETF at $9.55. They hand that money over to, say, Fidelity, and they get back shares in the ETF, which they could sell hypothetically at $9.57 and make 2 cents on every share of the ETF that they sold. So that's generally what happens and what keeps ETFs trading in line with their net asset value. We can go through in Q&A if it comes up. I'm happy to go back and sort of review it on the reverse side, if an ETF starts to trade a little bit cheap. But it's this ability to create and redeem new shares consistently all day long throughout the day, knowing what the underlying holdings are, that keeps ETF market prices in line with, if not their net asset values, at least the bid-ask spread of the underlying securities that they hold. Trey, let's go to the next slide. So the other question we sometimes get is like, are there factors that can impact the bid-ask spread not only of the ETF, but of the underlying securities. And these two things, I cannot emphasize enough, are extremely closely correlated. If the bid-ask spread on the underlying securities gets wide, the bid-ask spread on the ETF is likely also to get wide. So, the first thing to think about, and I think, liquidity is the first thing that comes to mind, but really liquidity also covers every other aspect that's on this slide, right? Market volatility impacts liquidity. The asset class impacts liquidity. The size of an ETF impacts liquidity. And then there can be some costs and fees incurred by market makers, which is probably a little bit too deep into the weeds, but that can also impact it. But let's just go sort of one by one. So liquidity, the ability to buy or sell quickly in the market at known prices. The more liquid the underlying security is, the less volatile the market is, right? So when we have days like yesterday where prices are changing quickly, spreads tend to widen out a little bit. That impacts liquidity. If we think again about asset classes, if you think about the S&P 500, most of the securities in the S&P 500, these are the largest companies in the United States. They trade at about a penny wide spread. But if you go down into something like the Russell 2000, you can very easily see, 5-6 cents wide on some of those securities. So again, the spreads tend to widen out as the asset classes change. Again, nothing is as liquid as the S&P 500. Well, treasuries. Treasuries in the S&P 500 would probably be among the most liquid. But when you think about other asset classes, you think about emerging markets, you think about high yield bonds, the spreads on these asset classes are much wider, and that is going to impact the bid-ask spread on the ETF. Similarly, the ETF size. How large is it? How much does it trade? The larger, the more liquid the ETF, the tighter the spreads are like to be, even when market volatility picks up. Again, it may widen out, but it won't widen out as much as the smallest, newest ETFs that have recently been issued. Trey, let's go to the next slide. So let's start thinking about next steps. And this gets us back to thinking a little bit more about tax loss harvesting and why it's a useful vehicle and how to think about actually doing it. So as I mentioned earlier, I think the very first thing to do is to review your portfolio, whether you do that yourself, whether you do that with your financial or tax advisor, entirely up to you. But I think it begins with identifying positions that you hold at a loss. The whole position may be at a loss, or there may just be some tax loss. If you've been buying something regularly every single month, you may just have some tax loss that are at a loss. So once you've identified that, the next step is to come up with a list of other investments that are going to be highly correlated, but again, avoid the substantially identical rule that the IRS has in place. If you sell the security, you cannot buy back something that is substantially identical for at least 30 days. So again, determine if you have losses that you want to harvest now. You can opt to wait closer to your end if you want. But again, my view is that the markets aren't always at their lows at the end of the year. If you can harvest the loss, manage and reinvest it into something that's in the same asset class, likely to be highly correlated, I think the question would be why wait? Like, banking those losses has real value to you and your ultimate tax bill at the end of the year. If you want to learn a little bit more, there's a lot of collateral on fidelity.com about tax loss harvesting. And you can see the link here. Visit fidelity.com/learn to read through some of those white papers. And with that, Trey, I think we've basically reached the end, other than my favorite part, which is the Q&A.
All right, Dominic. Well, thank you so much. A ton of great information in there. We do got a ton of questions coming through as well. We'll start with the top voted. And just a quick reminder too, Dominic mentioned this at the beginning here as well, but for some of the questions coming in, just a reminder, we cannot give specific tax advice. So definitely consult your tax advisor if you have anything in regards to your personal situation. We can't make specific recommendations, but if you do need help with maybe which funds to buy or sell, reach out to your local investor center, to your financial advisor, or you can give Fidelity a call and we can point you in the right direction with that. But Dominic, let's go ahead and start with the top voted question here. Actually, this was asked in multiple different ways, just regarding retirement accounts. But the question is simply, can this strategy of tax loss harvesting be used to reduce tax if the loss is in an IRA account?
Yeah. So IRAs are essentially non-taxable accounts. So you can certainly, if a position is down, you can certainly realize the loss, but you will not be able to use that loss to offset gains realized in your traditional brokerage account, or even from other asset. Like you might have sold a home at a gain. You might have sold anything at a gain, a piece of art. So you can realize the gain, the loss in your IRA, but you cannot use it to offset. And again, if you had gains in your IRA, those would also be non-taxable. So you don't have to worry about that either. So the short answer is, it's always worth looking again to stay up to date with what you own. How's it doing? Is it something you still want to own? Do you want to own something else instead? But as far as the value of that loss inside the IRA, there really isn't any.
All right, thanks for covering that. And Dominic, just to add to, we had that same question on every variety of IRA between Roth, 401k, and what Dominic's mentioning applies across all of these accounts.
Across the board. 100%.
Across the board. All right, next question here from Andy. Asked if there's a dollar limit on how much you can use as a loss in a given year, and if there's any limits on how many years you could carry over a loss.
So you can. There's no limit to how much of your long-term gains you can offset with realized losses. There's no, if you've got, $500,000 of gains and $400,000 of losses, you can do all of that. The limit comes into play at $3,000. So if you realize losses $3,000 greater than any gains that you've realized. So again, for simplicity's sake, let's assume you had $10,000 of gains and you realized $13,000 of losses. You can use the extra $3,000 to offset other ordinary income that you've earned throughout the year. Again, this is where you may want to check with a tax advisor, just for their perspective. Maybe there are some loopholes or snags where this doesn't apply, but generally it's $3,000 of losses in excess of any gains you realize can be used to offset ordinary income. It's a number that hasn't been revisited in decades. I wish they would. I do have some losses in my account that I would gladly use to offset some ordinary income, but 3,000 for the moment is the limit.
All right, perfect. Thanks, Dominic, for that one. Jumping on to the next one. This was definitely a very popular theme in questions. We had this asked a few different ways, but just maybe your thoughts, Dominic, on guidelines for using different but similar ETFs when it comes to that wash sale, right? What are some things people should be paying attention to maybe help distinguish what's substantially identical versus what may be, what may not be?
Again, so we're in kind of a gray area here where, again, I have to say, check with your tax advisor. I think even among Trey's tax advisor and mine, they may have a slight difference of opinion, and they're ultimately the ones who should be helping you to make the decision. I would say, look, a general rule of thumb is if you sold an ETF that tracks the S&P 500 from one issuer and bought back an S&P 500 ETF from another issuer, that is substantially identical. You've changed the issuer, but the underlying benchmark is the same. um, there may well be ways of, selling something like an S&P 500 and buying back the total market, right? So you're adding in like, call it another 3,000 securities. That may make your tax advisor much more comfortable. They're still going to be incredibly highly correlated, but they're slightly different. I think I also gave some examples of, if you move from an index fund to an actively managed fund. So even if you had an actively managed fund whose goal is to outperform the S&P 500, I think that will also be something that would make your tax advisor much more comfortable. But moving, simply switching the provider, but staying with the exact same index, I think is probably highly questionable. So, if you switch the provider, you switch the benchmark, or you switch from active to passive or passive to active, I think you're on probably much firmer footing.
Yeah, Dominic, and just to add, and maybe your thoughts here as well, this came up a lot too. I mean, we're focusing on ETFs here, but it could be from a stock to an ETF, or ETF to stock, or stock to mutual fund, or bond to bond fund. Lots of different ways that you can think about this, implementing this strategy.
Yep, absolutely. And in some cases, it may be that, I'm just trying to think off the top of my head, like, it might be that somebody bought semiconductors 3 days ago, which had an awful day yesterday, right? So, it may be that you own a large semiconductor stock that had a bad couple of days. And if you were to replace that with a semiconductor ETF or a semiconductor mutual fund, even if that security is in the portfolio, that again is probably something that your tax advisor is going to be comfortable with, but always best to check with them.
Yeah, in that same logic here, Dominic. I'm gonna jump down to, and then we'll come back to the top voted. But someone had a good question here, just about the actual implementation of tax loss harvesting. I just want to make sure we're clear, because Raymond asked, you had the chart up here where we showed missing out on some of the best days, or worst days in the market, how that it can impact. But the question is, since we cannot see what those best days are until after they happen, doesn't harvesting cause missing of these days? So maybe a little bit about that timing of harvesting in here, and how we're not ending up in a situation where we're maybe missing some of those days.
Yeah, I mean, 100%. I mean, I think that is the whole point of, and Trey, if we want to go backwards, we can go to that example of ETF A, B, and C. But, these were, ideas where these are all core bond funds. One is index, one's active. A is index, B is active, and C is active from a different issuer. And we can see, again, there's differences in their returns, but switching any one of these to the other one, again, going from index to active, I think it removes the substantially identical. Again, check with your tax advisor, or having a different active manager in the same category removes substantially identical. The chances of their portfolios being the same are extremely remote. And yet you can see that even over a 5-year period, yeah, there's a difference in the returns, but we're talking about like 1% a year. So we're not in a case where, you sold something, if you reinvested it into something that's in a similar asset class or a similar niche, you're going to capture a large percentage of any rebound that might happen while you're waiting for this 31 days, whatever it is, 30, to the 31st day, technically, I think is when you can switch back. You substantially reduce the risk of missing out. This is just a place to park your money, stay invested in something highly comparable, but not identical, and then be able to switch back 31 days later if you so choose.
All right, thanks for that, Dominic. Yeah, that key part of that is you're switching, right? You're switching in real time, right? Not getting out, sitting in cash. The idea here is moving into something with similar but not identical. Dominic, next question here is actually just regarding more of time frames for tax loss harvesting. And Mason asked the question: tax loss harvesting is for both. Is it for both short and long term, gains, or are the rules different when we're looking at different time frames?
Yeah, no, it's exactly the same. Ideally, look, short term. Again, if you have they're taxed differently, right? Short-term gains and losses are at your ordinary income tax rate. Long-term gains, I think the maximum is like 24% ish. So there's a difference in the amount. So you could argue short-term losses are actually slightly more valuable than long-term. So you want to offset short-term gains with short-term losses and long-term gains against long-term losses. But ultimately, you can offset with either. Yeah, I don't know. I hope that answers the question. And again, if you want to go a little bit deeper, talk to your tax advisor. You're probably all sick of me saying it, but it's just the rules and regs of not knowing who each of you are and what your specific situations may be.
All right, thanks for that one, Dominic. Next one here is a short one. Can you buy the same security after the 30 days when you do tax harvesting and avoid the wash sale rule?
Absolutely, and that is actually what a lot of investors will do. The other thing, that may be worth mentioning, but it's a slightly different way. It's a slightly different approach. So I guess the answer to the first question is yes. If you sold, I don't know. I mean, let's pick any name you want. I guess the name that's in the news more often than any other these days is NVIDIA, right? So if you sold NVIDIA today at a loss and bought it back 31 days from now, that is, from the IRS's standpoint, for lack of a better term, kosher. Alternatively, some investors, instead of doing it that way, will actually, there's something, known as like, essentially doubling down, right? So if you owned 100 shares and it's down, you can buy another 100 shares, wait the 31 days, and then sell the original lot at a loss. But again, now you're committing more capital as opposed to the market or to the stock or whatever it is that you're looking at, as opposed to basically keeping the amount that you have invested exactly the same. But the approach is the same. You just have to wait the 31 days.
All right, thanks for the clarification on that one. Kind of a general one here, Dominic. Bill had asked, in what circumstances would tax loss harvesting work best? I don't know if it's maybe specific things you're looking for in the market or specific percentage or type of losses, but any words of wisdom on what you may be looking for in terms of a circumstance to initiate tax loss harvesting.
Look, I mean, tax losses can be carried forward. So, if you're in a position where, you don't have any gains in your account this year that you've already realized, but there are some losses and you can take them, you can still use those in the future. I guess that's called carrying them forward. So I can't think of an example. Again, unless you can't find something that's close enough to what that you think is in your mind substantially identical, the IRS won't allow you to do that. But if that's your biggest concern, like this is the name you want to own, this is the only name you want to own, and you got it at a loss, then again, instead of realizing the loss and buying it back 31 days later, you may decide that you're just going to buy more of it, wait 31 days, and then sell off the original lot. But they can be carried forward. And so just because you don't have any gains to offset this year should not prevent you from looking for tax loss harvest opportunities.
All right, thanks, Dominic. Here's a good one. The why do it to begin with? A question we got: why do I bank a loss now, since I may not have a loss if I hold the security longer and it might turn around? But also, a second part of this is, do we wait till December to do this? I know we talked a little bit about this, Dominic. We're doing the webinar in September versus in December. Thinking about the timing of that, does it have to be at a certain time of year? And again, the first part of that, why do it to begin with? Why not just hold a security and see if it comes back?
I mean, look, each to their own, and you certainly can hold a position that's at a loss, and again, hope that it comes back. In many cases, it does. How long it takes, I don't know. Again, I guess there's a time value of money. If you've got a big gain that you're going to pay taxes on, and you can realize a loss on a security while then reinvesting in something that's pretty comparable, there's value in that. but you can absolutely just sit on losses and hope that the security not only rebounds back to where it was, but obviously higher, which was the original intent of buying it. So yeah, I mean it's an option. It's just if you have gains, this is a way of trying to reduce your tax bill. As for the December point, again, again, I think if we Trey, if we go back a couple more slides, I think we had the one with the green and red bars and the blue dots. The point on this slide here is, why do you not wait until December? Because December is not, the market doesn't give you exactly what you want every time, right? Sometimes the maximum drawdown in the market is not in December. Again, if I go back to 2020 more recently, you can see, it looks like, the S&P somewhere in like the March, April timeframe, I don't remember exactly, was down, call it 35%, but ended up the year up. So if you had taken, again, let's just for argument's sake say, an S&P 500 portfolio and sold it in March, you'd bought back something like the total market, or you'd gone from an index fund to an actively managed fund, and then at the end of the year, the market was up, 20%. You would have participated in pretty much all of that upside and banked the loss at the same time. So, you can always wait till December, sure. But I think that there's value in trying to harvest losses whenever they sort of appear in the account, and you can find something that you're reasonably comfortable is going to be highly correlated, but not substantially identical.
All right, thanks for that one, Dominic. I think the next couple of these we've probably already touched on. We did have one too, just to clarify. We've talked a lot about identical, but offsetting. Can you offset gains and losses in completely different funds? Someone asked the difference between sell a bond to offset a loss in stocks and some of those different style of investments.
Yes, yes, and yes.
I like the easy ones, huh?
If you sell an individual bond, if you sold individual bonds, you can use that to offset losses in bond funds. You sell an individual stock, you can use that to offset losses in stock funds. I mean, there, I think there's no question that you're you've avoided the substantially identical, right? Because you've gone from something that's an individual security to something that's very broadly diversified.
Yeah, I think also, Dominic, thinking of the categories, you have long-term capital gains and short-term capital gains, and whether you sold a bond for a long-term capital gain or a stock or an ETF, they're all generating what that IRS sees as that, long-term, capital gain here as well. Dominic, we had a lot of kind of follow-up questions I'm seeing just about the wash sale. Thinking about it, if you sold a security and you did actually buy it back within the 30 days, walk us through what actually is the penalty. Maybe that's not the right way to put it. How does that actually impact somebody's taxes if they do a wash sale?
So the biggest downside to doing that is you cannot use that loss that you realized to offset any gains. That is I guess the painful part of it in the short run. Longer term, what actually happens is, let's just for argument's sake, you had a security that today is that you bought it originally at 30, you took a $5 loss, but then you bought it back too soon. What actually happens is the original cost that you had at 30 will be increased to 35. Meaning that any future gains or losses that you may take on that position will, if it's a future gain, it would be smaller, right? Because your cost basis went from 30 to 35. If it's a loss, all right, so the security goes back down. Now your cost basis is 35, not 30. So if it's a 20, you've now got a $15 loss as opposed to a $10 loss. So it doesn't disappear entirely. There's still some value in it if you violate the wash sale rule, but what you're not getting is probably what you originally intended, which is to offset your realized gains. I hope that's clear.
Yeah, absolutely. And maybe some of the follow-up, Fidelity will track that on your cost basis recording. If you do that, it will show up on your tax form. So
yeah, that's certainly true at Fidelity. And again, I think it's most financial service firms automatically adjust your cost basis as such.
Perfect. Thanks, Dominic. With that, I think the next couple of voted questions we did touch on through those here as well. So we will go ahead and wrap up from here. I want to just remind our audience, Dominic mentioned the fidelity.com/learn. There's a ton of great articles in there that follow up on this conversation, go more into detail on wash sale and tax rules. So definitely take a moment to check those out as well. And as we mentioned multiple times, always great to check in with your tax advisor, as well as your Fidelity financial advisor here. If you do have those specific questions about maybe what is the right fund or right ETF, is this a good time for that? Reach out to your advisor here to dive deeper into that conversation. But hopefully from today's webinar, I have a couple of great points to take away. As a reminder, if you'd like a copy of today's slides, you can click that link to download directly below your video screen. But with that, Dominic, definitely want to thank you again. Thanks for the presentation. Thanks for joining us, of course, hanging out to answer a few of those questions with us here today.
Always a pleasure. Love doing it and look forward to being back again soon. I hope the audience feels the same way.
All right. Thank you so much, Dominic. Thank you to our audience as well. We'll look forward to seeing you at the next one. All right. Bye-bye.